Hello, everyone, and thank you for joining our session today. Before we begin, we have a few housekeeping notes. This call is available only for clients and associates of Jefferies. Media is not allowed to be on this conference call. If you are from media, please disconnect from the call now. This session will be recorded for the replay. By remaining on this call, you consent to the recording of this session. If your real name is not on display, please change to your full name so we can ensure attendance for this session is taken. To avoid disruption, everyone is muted by default. If you find yourself unmuted, please click on the microphone icon to mute yourself. During Q&A, if you have a question, please use the raise hand feature located at the bottom of your screen or at the bottom of participants window. For those on the phone, please press star 9 on your keypad to raise and lower your hand. When it is your turn to ask a question, please remember to unmute yourself. With that said, I will now turn the session over to Prakhar. Thank you.
Thank you, Manira. Thank you, Srini. Thank you, Parag, for being part of this summit. Really great to hear how HDFC Bank is thinking at a broader technology initiative and investments. And, maybe if you are okay, we could start with some bit of a broader thoughts, Parag and Srini, about how at a broader level you are looking at the digital and technology strategy at the bank. Especially as the pace of upgrades and transformation has been pretty aggressive. We've seen very customized level of platforms also come through, and probably the speed of getting outdated or the risk of getting outdated is equally high. So how, if you could put some light on how at a broader level you are able to think around the strategy and the initiatives from the bank's perspective.
Okay, I'll probably start to intro correct. But Prakash, the way to think about our digital strategy is perhaps think about it in two aspects, and then there are some enablers that come with it, right? One is something that we call internally the digital factory. The other one is the enterprise factory. These two are the mediums for delivering our strategy, right? So those are the two kind of pillars around which that strategy is built. The digital factory is something that focuses on the applications that are called better user experience, customer interface, right? And that includes the neo-banking and all sorts of things. Parag will talk more about various technology that goes into it, but that is something that is what is there in the digital factory, right on the cloud. So that means it is not just getting certain things enabled, but it is straight when it is done and it is implemented, it is all in the cloud, right? So that is, think about that as digital factory. The enterprise factory is taking the monolithic legacy architecture that we have, converting that into microservices, putting it on containers, and opening up the APIs to provide banking as a service and get this on the cloud. Right? Today, none of them are cloud ready or enabled. Now, this process enables that legacy architecture to be completely revamped into the state-of-the-art tech and get that done. So these are the two pillars, and this is a broad overarching thing about what that means. Within that, if you think about how the method in which it gets developed, this is on a journey that we have started, which is a co-creation journey with various tech partners, tech startup partners who are very nimble, embracing the latest kind of a technology developmental techniques that they all have, leveraging into that, and getting this done where we provide the domain expertise and we bring in those kind of startups which have the technology expertise and develop it. So we own the intellectual property as we provide the domain expertise, and we try to keep the cost in an optimized manner in this way by bringing in new technology in. So that's in terms of how you go about getting that. And to do this, there are some enablers that are required, right? Enablers, you can think about people as a very important enabler that is required, right? Bringing some people on board, in addition to getting the technology partners to do, you get people also on board, and that requires getting the right kind of a compensation structure so that you're able to attract, like the way 2-3 decades ago, it was about the investment banking and the treasury professionals needed a separate type of approach to bring them on board. That's the kind of an approach we have embarked on. And we have several such professionals onboarded right now, right? So it calls for a different mindset to bring people. The next thing, enabler, is also the work environment. So it's not just attracting the best of the talent, but the best of the talent wants to have an environment which is not a traditional banking environment, right? It needs a different type of environment. So we embarked on it, and we already have a couple of such spaces which are the tech type of mindset spaces to work with. And so we are there. So with that, perhaps I will get to Parag. He'll talk more about, but these are at least the way to think about the pillars and the enablers that go with it.
Yeah, thanks, Srini. Thanks for setting that background. So I'll reach the point which sort of Srini was talking about in terms of the retail, our enablers, et cetera. But I'll slightly zoom in from a slightly different perspective. I'm not saying anything new, but I think it's important to reiterate the point. HDFC Bank is a very large bank, one of the largest banks in the country, market leader in most product categories in which we are in. Okay, and of course has a strong, robust, sustainable, long-term business model. It's been built on certain principles over the years. Okay, and we continue to sort of espouse those philosophies and values, and that focus will always continue. Having said this, our digital or digitization journey actually started almost 7 to 8 years ago, when what we call, the first phase of digital transformation was what we traditionally would call, digitizing a lot of the back-end processes, or what typically would call straight-through processes. So we've done a lot of work at the back end over the last 4, 5, 6 years in terms of driving a lot of straight-through processing at the back end. Now, these are below the bonnet changes, if you may call so, not really necessarily visible directly. The outcomes of those are, of course, visible, and therefore you saw many seminal launches which we did, whether it was the PL 10 seconds and many more such kind of the instant loan against share loans and a couple of other principles. But that was phase 1, and that itself has sort of given us a big boost to moving to the digital transformation tool. Today, what we're in is the next stage of our digital transformation, if you may call so, wherein, keeping in account that we're a very large bank with a huge set of strengths which we've built up over the last 20 years, we sort of broke up our transformation journey into 2 parts. One part is we did not have the liberty, unlike many other new entrants in this space where you don't have a legacy, we do not have the liberty of just ignoring what we've built up. So there, our transformation journey is about looking at existing systems, modernizing them piece by piece, and taking them on a journey of what we call following the core, because very clearly you have 60 million plus customers who are today transacting with you. We are also the largest transaction bank in the country, supporting significant large volumes of business which happen. It's a journey which we've sort of embarked on, and this is where, zooming in straight away into what we call the enterprise factory, the role of the enterprise factory, which is a dedicated, focused, tasked set of people on taking my existing systems, working very closely with the tech partners which we've always worked with, and of course a newer set of partners to what we call modernize the core. In a sense, the approach which we've used there is very simple. Typical monolithic systems would mean hard coding right from the customer level there, the interaction there, right down back to the GL layer. What we've done is actually we've broken it up into 3 or 4 parts, segregated the GL layer, which is the core accounting layer within the bank, the processing layer which lies on top of it, the middleware layer which is above the processing layer, and finally the customer layer. Broken them up into parts, taken each piece and applied the newer methods and technologies, etc., which we sort of doing. So, for example, in the processing layer, given the kind of volumes which are expecting on the digital world, we said resilience, clear 24/7 capability to stand up, and of course, infinite scale was the key attributes which you need to build in, and therefore, cloudification is one of the core enablers which we're doing in the core processing layer. In the middleware layer, the focus is on building connectors, or what we call in today's world APIs, and therefore proliferate and create an entire set of APIs driving microservices layer. Every small process would be converted into a microservice and then exposed as APIs, and therefore ensure that the inner core systems of the bank are equally connected, so that you can actually have connectivity, which is not an attribute of a monolith system, and building the API layer. The last layer, which is the customer layer, I'm giving you a brief of how we've segmented our transformation strategy. The customer layer is therefore taking these APIs from the middleware layer, working with another set of partners to sort of modernize the UI, ensure that product release changes keep on happening, to doing mapping a lot of the UI, UX, and the customer experience on the customer layer to what expectations of the customer is. And therefore, when you then take the entire monolithic stack, we've broken it up into 5 parts, and the combination of this transformation strategy is exactly what we're talking about, which drives today the whole volume is 60 million, and that's driven by the enterprise factory. I'll talk about the other core common enablers subsequently because they apply to both. Parallel, and that's like one track of a railway track. The second parallel track of the railway track is exactly this. How do you also build new capabilities in the digital world from scratch? And that's the role which is tasked to the digital factory. The digital factory is to create digital assets, digital capabilities, digital competencies, imbibing the best practices which are available in the digital world, which are being used by many of the new fintech or the new tech companies, which is starting originally from the product thought process of saying, I will be only mobile, I will be only cloud, I will be only containerized, I will build in resiliency and infinite scale upfront. My systems will be designed to take on 100x of the capacity which conventional systems would not do. My systems will ensure that I can make product changes on the fly and have product releases or releases in weeks and days, as compared to probably the earlier way of working, where it could be probably in months and sometimes even years also. Okay, building very flexible, do-it-yourself capabilities from the customer, using the same APIs which I talked about in the enterprise factory, so that customers can do a lot of self-service transactions with a huge amount of data which could be fed back to the customer to sort of give them information. Building all of this on a layer of what we call artificial intelligence, and using those capabilities to look at all customer data available within the data lake of the bank, and being able to come out with meaningful suggestions, nudges, information, cues, etc. Again, to help this do-it-yourself journey. And of course, at the top, building an extremely, if you may call so, modern, contemporary, micro-segmented, customized customer interface layer. Okay, so that customers, we could target multiple segments of customers. That is the core role of the digital factory. Okay, and therefore, when you see, that's the second track of our transformation journey, which we are currently in. Okay, and as the journey progresses, it's obviously in a 24 to 36 month journey. We've embarked on this journey. A lot of projects are already in space. Okay. And we have built sort of connectors between the digital factory and the enterprise factory, so that's the best practices and services. Coming to the enablers, we talked of people, and the second is the partnerships and alliances approach. In people, very clearly, what we're doing is investing in the existing set of our tech resources, which is reskilling them, a lot of job rotation, upskilling people to work from the conventional way in the new digital world, and that's a task which has been on for almost a year. The second bit of the people competencies is obviously bringing in completely new capabilities, DevSecOps capabilities, cloud engineering capabilities, microservice capabilities, huge data lake, along with AI, ML, deep data, analytical capabilities, etc., so forth. Okay, and this therefore we're also therefore transforming the core soft capabilities of the bank to be able to not just manage a very large edifice, which we've also built, but also merge it with the new capabilities which are going to help us be ready for the next 20 years of the business. The second is partnerships and alliances. Here we're very clear. That as a bank, even though we may be the largest and the best, no doubt about it, but we will not be able to build all of these capabilities alone. Okay, and that's where we said, let us partner with the best in the industry, global best practices, look at the global partners, okay, whether they are back end or front end, okay, and forge alliances and partnerships so that we can bring the best to the table and help us in this transformation journey. So whether it is at the core processing layer, whether it is at the middleware layer, and also at the customer interface layer, we've partnered with multiple people. We work in very agile, very nimble, very small, if you may call, agile pods, okay? A core set of bank people, a core set of the engineers or the capabilities from that partner, work with, if you may call so, well, the approach is, earlier you would have a very large project which would have a gestation period of maybe, say, 10 months, 12 months, 18 months, etc. We've broken that up into small manageable pieces, which sort of fit into this pod and agile pod culture, taken clear objectives, shorter time frames, work in a parallel system. So the pods actually have a combination of the business, the product people, the solutioning people, the digital experts, the engineering experts, the DevSecOps experts, and a mix of both. And of course, because we're finally a bank and we work in a regulated atmosphere, we also have participation from the control functions, the risk, the audit, the credit policy wherever it's required, the IT risk, the information security groups, compliance groups, etc., sitting in those pods. And each of these people in the pods are empowered with to take decisions on the fly. They're completely aware of the objectives. There's a joint accountability to deliver the output of the pod within defined time frames, and decisions get taken during those pods. Only in rare exceptions where there's a need to sort of go to your supervisors or your superiors to take policy decisions. Those are the only where you go outside the pod. Otherwise, it's almost like a self-sufficient unit. So that's the new way of in terms of working in terms of the pods. And therefore, partnerships and alliances, not just back end, but also front end, which are customer facing, are an important also part of the same digital transformation strategy and getting ready for the next sort of 20-25 years. But like I said, taking a very large existing bank, making it that much more nimble, building extremely importantly, and one of the learnings in this whole phase is, and because I also wear a business hat, what has happened with the emergence of the digital way of working and so many new players coming in, you see across multiple categories, the denominator is multiplied. What I mean by that is very clearly, consumption in every category has got up multiple fold. What does that mean? That's great for business, but what does that mean from a tech company or from a bank like us? It means that my systems and capabilities need to be able to handle multiple X volumes, loads, okay, to cater to that kind of demand. In addition to, of course, having a much more digitized go-to-market strategy, etc., etc. Okay, and so therefore, like I said, one part of the digital transformation strategy is to cater to that huge kind of volume, load, resiliency, non-fail, having fail-safe methods, sort of backups, etc., etc., etc. Okay, and building that nimbleness and agility in our capability to manage those volumes. Partnerships and alliances are going to help us there. Partnerships and alliances are also going to help us focus on segments which we hitherto say the bank was not very strong in, or completely new segments. So using these newer methods and technologies to actually co-create products and go-to-market strategies to penetrate many of these segments. So like I said, the enablers, people, building those skill sets, it's almost like on the ground when you meet some of these pods and look at the way they function, they're like tech companies who are working with a banking license almost, philosophically. And that's the kind of culture which we're sort of building and trying to change. Simultaneously, like I said, we will build on our core capabilities, but also work very strongly with partners to bring together newer sets of skill sets where together we can go to the marketplace and build our strengths. So that's in a nutshell are the details of some of our core strategy transformations.
So, thank you, Parag. Thank you, Srini, for those. And it's great to see too many things happening also at the same time. And maybe one related question that also happens, and I'm sure you guys will be discussing this thing day in, day out, is how to time it, how to ensure that there is enough revenue to absorb the cost, and how do we ensure the investments pay off rather soon. So at a broader level, how should investors also think about the cost that the bank is investing, or the money, the investment that the bank is doing. I think cloudification is not just another investment. It's a fairly large commitment. It's a scalable investment. And you've in the past also discussed what it means from the cost to income ratio, etc. So could you kind of help us marry the two parts, the investment side and the cost revenue side?
Okay. See, the way to think about cost is like this, right? There are some costs which are capital in nature, so is over a period of time. And there are certain costs that are operating costs, is a period cost that goes, right? Like everything else. From a revenue point of view, this is not something that you're waiting to implement and then start getting revenues. This is something this is an ongoing running business, right? The business is ongoing, and you are, call it for lack of another better term, refurbishing technology. Right? For example, the one that is soon going to come, or a few things that are soon going to come. Take the example of the customer experience hub, right? Is one of the state-of-the-art technology that is going to come in. If you think about the customer experience of what it is going to do, it is going to give a better kind of a product and a RM and a customer engagement for a better product available to the customer. And so thereby, we have seen that the 80-20 rule applies, that when you have a relationship management, the income that we get, right, is multiplier times where you don't have the relationship. So that is why the revenues are supposed to come quickly through the relationship in that instance. If you take another instance of the Pays app as such, right, which could be a few months away by the time the new Pays app hits the market, it is a running product. We have certain things. You take it out and put new thing, and there are two expectations you have. One expectation is it gives a better customer experience, right? And multitude of transactions that it can do than the old one, applying various learnings that we got from there, put that in. So that's one, right? So it gives for the customer, go to, I want to do this. And for us, that expands the kind of transactions that we can do with it. And so thereby, it makes many other customers embrace it, and potential to be customers embrace it and bring more people on it. Right? So that's, again, it's not something that you need to wait for long. Another way to think about all of the, I gave you one or two examples of how to think about returns. Another way to think about it is we open branches all the time, right? Call it the year before COVID, we opened more than 400 branches. The year after COVID, we opened 350 branches, right? If God forbid and everything works well, we may have another 350, 400 branches in this year too, right, as we open. And the gestation period for a branch is actually bigger than the gestation period for any of these technology implementation, right? Because there you go to a new market where you're opening, and you're bringing in new people, although you will infuse new and old people into a particular branch, so you don't leave all of them as new. But still, you can see the relativity in terms of technology, new technology implementation versus a new branch opening. And the branch has got a typical more than 2 years to get off. And then you got several kind of a stages, a 3-year, 5-year, 7-year, and a 10-year stage in terms of the maturity model that it takes, right? So compared to those, the traditional banking approaches, which has got a different life cycle maturity model. Technology has got a much quicker maturity model from that sense, right? So that's at least the ones that we are envisaging and doing is all about that kind of an approach.
Got it. And Srini, with all these investments, any change in terms of the way we should look at, at a whole bank level in terms of the cost to incomes and stuff like that, compared to the guidances you have all given in the past?
No, see, in the past, normally as a bank, we don't give guidance, but in terms of cost to income, that is something that we have done. Few times on a few occasions pre-COVID we have done, which is the cost to income will keep improving and it will get to mid-30s in a medium to long term. That is what we said, medium to long term being 3-5 years type of time frame. And COVID had an 18 months, 24 months hiatus in that process, so be it, right? And in the process, by the way, the cost to income came down to 35 or 36, which every time we call out to say, this is not consequent to we taking a proactive action to rein in the cost in a different way. It was not due to that. It was simply a mixed change where when the retail goes down and the wholesale goes up, that's a different kind of a cost to income dynamics that happened there. And so that is what came now. And when the mix swings back post-COVID, where retail goes back up to its original level and the wholesale keeps going down, you will see that the cost to income goes back to, it was close to 39 the year before COVID, right? March 20 year, the cost to income was 38.8, right? So call it 39. So it will go back there. And in a quarter or so, if it touches 40, I won't be surprised. That is what we've been saying. But that is the kind of a level things will go back, and then it will go back down in a medium to long term to mid-30s with one technology, number two scale. And the technology also, by the way we look at the technology and we are starting to, and we will articulate it as we go along. See, the way you will perhaps also start asking and looking at it like that. So you have to look at the cost of acquisition, the cost of servicing, right? These are the two broad elements of the cost. If you take the total cost, how much does it cost for you to acquire? We believe in the digital acquisition mode, the cost of acquisition will be lower than a traditional cost of acquisition. In the digital, when Parag described what he is doing and fully implemented, the cost of servicing will be lower than the traditional cost of servicing. Right? It is not about absolute level. It is also about the way what it does and what is the unit cost of that particular activity that happens. And the product mix can make it very different. Example of the product mix I gave you, the traditional versus today, COVID period is the wholesale retail at that higher level product mix. But then you go into micro level product mix, it can have a different dynamics too. So it depends on those which type of individual product that goes up and goes down. So similarly, for example, he is very close to think about the cards, right? As cards starts to ramp up, the cost of acquisition is pretty high. The cost of servicing can also be high there, right? And it comes with good returns, high returns too. So it depends on the product mix that goes into the entire equation.
Sure, got it. And another question, maybe two more questions from my side before we, open up for a few of the audience questions. On the regulatory side, if you could shed light on, three broad aspects that are, kind of coming up. One, as a bank, when you are trying to make certain forward-looking investments, partnerships, etc., what sort of regulatory support would help you to, constructively move forward? Is there an area where, the regulator can help banks or NBFCs, whichever way? Second, there was this recent RBI Working Group Committee report on digital lending and its regulation. If anything that is relevant from your perspective, it makes things clearer, etc. And And the third, something that has been lingering, the RBI, if there's any update on this RBI issue on the tech new initiatives of the bank, if there's any update on that one. So if you can address these three aspects around the regulators' participation here.
Maybe I'll start with the last one on the regulator, then we'll talk about the other customer. See, from a regulator, from a digital transaction point of view, digital 2.2 or whatever, what it says is that until the regulator gives that clearance, anything that we are doing in the new age digital technology, they call it digital 2.0, which is not a very clear-cut kind of a bright line test for it. We have a committee that looks at those kind of things, that we get the clearances to do any of those, right? But things that we are normally doing in business as usual. If you're changing the approach of a tool that helps in your better customer relationship management, that is a business as usual. If you think about the Pays app that we have, but it is getting to an end of support or a vendor change or whatever, then you bring in a new, that is another kind of an implementation that goes. There are certain things that goes as business as usual, right? That's not a... If we want to have a new bank as an example, that we need to get the clearance, etc., etc. That's so that you get that context of what we need. What we need to do, most of what we had to do in a short term, medium term, we are more or less applying. And it was done in April kind of a time frame, April-May kind of a time frame. And the auditors have come and reviewed it. The report is with RBI. We have had a few dialogue and kind of a clarification or discussions we have had. But we are waiting for the clearance at any point in time, right? So we should be patiently giving them that breadth of whatever is required, and internal process one has to follow to get that. So that is where that in terms of the approval process or a clearance process comes in.
Yeah. So taking the other two, start off with, I think in this whole era of change, of what's happening, there are multiple new players coming in, there are traditional players, multiple new players coming in. So the role of the regulator, as we're seeing it, is very clearly, and the top three amongst multiple things which they're doing in terms of priorities, as I see, is that obviously seeing that with the entrance of the emergence of many new players, systemic risk, ensuring who are the participants in this whole game. Banks obviously under the regulation have a particular role in this whole era of growth, liabilities, assets, etc. But looking at systemic risk with the entrance of this thing is one core area which I think the regulator is focused on. Okay, and some of the thrust of the whether the white papers or the kind of guidelines which is sort of introduced, I think clearly focus on that. The next is data privacy, and issues like who stores data, who's accessing data, etc., etc. And the third is, of course, the customer being at the fulcrum of all of what the financial industry is doing. Are the customer interests being met? Are there transparency issues? Have you taken consent? Is there a redressal forum for customers, etc., etc., all of that, so that the customer interests are taken. These are the three core, if I may say, primary areas which, amongst the other areas, which the focus is looking on. So, and as we see over the and especially with a couple of the white paper announcements, I think which are coming in, you can see the elements of these three areas coming in the guidelines. You talked about a recent guideline in terms of lending, digital lending. Very clearly, they've outlined what is the role of banks in that entire space and what are the role of other non-bank participants in this whole ecosystem. Because, like I said, one part is the pure financial layer of who's doing the lending, who's taking the risk, who's doing sensible underwriting, etc., etc. And the other side is how are you providing the digital means in which customers are able to be onboarded. What's the customer experience? Is it transparent, etc., etc.? These guidelines, I think, are very positive and are only going to sort of help complement all the changes which we talked about over the last half an hour in terms of entering new markets, helping partnerships and alliances, etc., so that you can actually co-create products to sort of enter the whole space. So a lot of these things are very encouraging, and I'm sure the regulator is looking at even more sort of a more positive way of doing it. But net, I think I think they've acknowledged very clearly that digital is here to stay. Digital has actually expanded the whole scope of customer transactions, and they're now putting in place in a measured manner, taking into account short-term and sort of long-term view on how the growth is going, a set of guidelines, measures, etc., which sort of we are sort of encouraging with. I hope that answers your sort of question.
Yeah, it does. It does. And before I just take the next question, I'll probably ask Munira to help people raise hands if they have any question. Munira, would you like to go ahead? I think. I think we already have a bunch of them, so I'll probably hold on to my question. Sachi, would you like to go ahead?
Hi, thanks, Fakir. Thanks for taking my question. The question I have for you, and I mean, Srini, you can respond, or you can decide who wants to go for this. But this is more of a philosophical question. And the question is, has technology lowered the barriers to entry? Is it almost a disadvantage, to be an incumbent with legacy monolithic systems versus, the new age, nimble players and so on and so forth? Or do you think that actually that you are actually far more stronger now, because even in the new age, you bring something to the table which the newer players do not have, such as, your historic underwriting data and so on and so forth. And as you answer this question, I think for all you incumbent, already existing customers, I understand you have the data and you have the relationship and branding and everything. But I suppose India is so underpenetrated that my question is more focused on the new up for grabs kind of market, and whether in that space an incumbent is disadvantaged, or do you have any advantages there?
Okay, excellent question. Thank you for asking, Suji. See, the way you think about this, your question is very apt and exactly required at this stage. But the way to think about it is like this. Banks, incumbent banks like us, have a few strengths. What is it that we bring to the table, and what is it that the new age tech brings to the table? That's what you want to distinguish, and that's where lies in the strength and the development and the partnerships that are required. That's where we are bridging it. So it will connect to what Parag was explaining. What is our unique strength or USP? One, since we are a bank, robustness is a process for onboarding customers. Call it the KYC, call it the AML, right? At one end of the spectrum. Call that. That is our USP, and that is what we are here for to do, both regulatorily and for the betterment of the bank. That is most important, and that's where we specialize in. That's one. The second aspect of this is the data and transactions that come. You needed to have a great deal of a database, which is what we built over the last 23 years. The first 2-3 years, we were dealing with high-level corporate cash management. Then we got into retail, and then we got a lot of data and the data warehouse. That is a repository of fantastic data elements which are there. Now, having a data element alone will not be one. It is a huge of 22 years, 23 years data. Then putting a tool on the top to work on the data. That is something that one has to specialize. And the tool gets wiser by the day, right? It doesn't. We've been having the tool for a long time too. But the tool, because the tool learns, and as we implement new technologies of AI/ML, the more it learns from the data, the more experience that you're able to bring it into it, it gives you better outcomes, which is what is another kind of a specialty. So it's not enough to get a 1-year data or a 3-year data or a 5-year data and say it is done, right? We have a 20 to 23-year data. Even there, we feel it is not enough, right? Because every situation presents different kind of challenges that come. So that's another thing. So you need that. Then, so you got analytics on top. Then you got a credit scoring methodology that has to come with it. And again, that credit scoring methodology and the credit scoring process comes with the experience, comes with kind of a learning that is a continuous process that goes on, and that's what happens in the bank too. And the last aspect, there are several other things, but then the last aspect of this is the collection aspect, right? Which is all said and done in a digital-only model, where you say that 98% I collect. It is about the 2%. Our delinquency is 1.35, right? It is about that last 1% is what we are talking about, that you need to work on it to collect. And so you need a collection mechanism. You need to have feet on street, ability to connect and physically meet the customer. So many other things that go with it, right? And that's also part of the working group paper, I think, in terms of the how you get to a collection approach. That is also part of in the digital side, right? So these are the kind of certain things, uniqueness that a traditional bank, legacy incumbent bank like us bring. Okay. Now, if this is what you have, then what is attractive? Now that gets to the other aspect of what you touched upon, which is think about the tech players, or think about this the new age technology players bringing in, right? It's the UI UX that bring in the ability to attract customers onto their website, and the ability to nimbly make changes to customer needs and be adaptive in technology. So that is something. Now that is where we come in to say, okay, we have to refresh ourselves. There are certain technologies that we want to own, we want to develop and be there. So we refresh and so be on the cutting edge. And the second thing is that where we cannot or we don't need it for expediency, we partner and try to do that. That's part of that approach that we do. Then your last part of the question is that, okay, now that you got the incumbent legacy strengths and you're tapping in on the new strengths through different approaches, one developing and two partnership, that's what you do. Then what is it, the third aspect that you talked about, how do you get the customer? So what the combination of this does is that it breaks down the barrier, it breaks down the time to get the customer, it breaks down the time to deepen the relationship with the customer. All of this combination is to make it worthwhile, to crunch the time. Previously, if we were thinking that to go to a market, for us to discover and plant our flag and start to do certain things could take us a year or two. Now we can do it in a week to 1 month type, right? Because you got a different type of a tool that takes you into the customer. We don't need to wait for the customer to come in. We go to the customer where there is and make our product and services available and bring them on digitally and do it. So it essentially ultimately breaks down the barrier for reaching the customer and making the products available. Let it be remote locations, let it be metro locations, doesn't matter. And also across the demographic of the customer from the new age millennials to the middle age to whatever approaches, again, across all of these segments also you're able to get on to this.
Thank you so much. This is a brilliant question. If I might just piggyback one more question. The technology strength, and we've also spoken about, all the investments that have to be made for that. Is that going forward, is that going to be a source of differentiation in your competitive advantage? Or do you think it is almost table stakes in that everyone will do it, and people, who can't do it themselves, they will partner with the new guys, and it's basically table stakes? So is it a differentiator or is it table stakes?
Another very good question, Sachi. Very nice question. I'll tell you, the technology is available for all. So it's not something that is proprietary or unique to us. Partnerships are available for all. Again, there's no exclusivity or anything of that sort. Everybody can do it. But what is that then that can be the key differentiator? The key differentiator is about the execution. Just about the execution, meticulous execution, that is what makes it different. So again, there is no new product, new strategy, new thinking or anything like that, right? It is all about execution. That is where we, the incumbent bank, which has demonstrated top-class execution, we are trying to take this execution in the new arena. That's all we're trying to do.
Perfect. Thank you very much, Srini.
Thank you, Sachin. We have just two more questions, and probably I'll, in the interest of time, I'll request participants to limit their question to one. I'm so sorry for this. Deepak, would you like to go ahead?
Hi, am I audible?
Yes, please.
Yeah, hi. Thanks, guys, for sharing the insights. Two questions I have over here. One is basically when you are going to this digital transformation, what decision you made, in terms of whether you do the development in-house or you outsource it, partner with technology firms, is one. How did you arrive at that decision? And second is when we talk about cost of acquisition and servicing, also this cost of development in-house or partnering with somebody would help you. So these two questions I wanted to understand. How did you arrive at, and what decision was made at that time?
Okay, so I think reasonably clear. We're clear that core capabilities and competencies, technology which is going to help us in those clear areas. We said that this is something the bank would like to own. So, for example, just to give you an example, when we embarked upon our cloud journey, we said whilst cloud services are available, there are the top 3 providers globally. And they provide all the bespoke services for many large and medium organizations. But we said no. Going just beyond capacity or cloud, which is sort of giving you the capability to process large number of transactions, we said, how can we convert that capability into something which is a cutting edge for us? So our cloud strategy itself, which we evolved, is something which I think, which I believe is pretty unique in the banking space, is that today we're actually working simultaneously with all the 3, 2 right now and the third one in a couple of months, cloud service providers to create what we call a hybrid in-premise cloud strategy. Okay, what are the advantages of that strategy? We said one is that it's obviously going to give us, going beyond the conventional way of looking at backups in DR, actually a redundancy even between the 3 large global cloud service providers, so that even if, God forbid, something happened, it gave us a fail-safe capability at the scale which we operate. I think there's no question that we can even allow an ounce of sort of outage. So within cloud service providers, we built up inbuilt capabilities. That's number one. The second other capability we said is, as part of our partnerships and alliances strategy, if we're going to be needing to deal with many number of large tech, small tech, fintech partners, okay, cutting across large, big, medium, and small, and these partners itself would be on the cloud. What typically would happen is that even to sort of start working, it would require a huge amount of, you may call so, integration of working processes, etc., for even the partnerships to work. So what we said is, we created what we call a landing zone, which is almost like, I compare it with, the base camp before you climb Everest. It's like an acclimatization zone. It basically ensures that any partner who works with any cloud service provider can quickly come onto this landing zone, and in a jiffy, as compared to conventional integration times, actually marry his systems with our systems, and we can actually hit the ground running in a much more nimble and faster way. Okay, thereby what we've done is, we've actually ensured we've created an environment which is almost akin to the environment in which that fintech could be a large or a small company works. Okay, and so it makes partnering even that much more easier. Okay, and of course, even for small fintechs who typically would not want to work with large organizations like us because they say it's too cumbersome, etc., we've actually made that process simpler. Now, this capability, we said, why would I want to sort of outsource it? I would like to in-house it, because that adds to my core competency and becomes actually a differentiator going forward when we sort of doing it. So that's the thought process we had when we identified areas which we would like to invest in and build in-house, if you may call so. and what we would sort of do on a variable basis, or work with partners, etc. outside. I hope that I hope that is sort of clear. Does that answer your question?
Yeah. Thanks a lot.
Thank you. We have the last question from someone from White Oak. May I request you to introduce yourself and go ahead with the question? Thank you.
Sure. This is Anand Bhavnani from White Oak. Apologies, I couldn't change my name, so hence the error despite your request to keep the name. My question is, we talk about execution and we have delivered execution. So isn't it logical to expect technology to help us lever our executional capabilities and thereby help us garner the next 10% of Indian banking much quicker than the first 10%? And why would be I wrong to expect that to happen? So that is the first question. And second is how much of the benefits of technology, assuming it's a sunk cost, right? Beyond a point, it's a sunk cost. How much of the technology benefits would we want to keep within the bank or pass it on to customers? So whether we would, cut down on our margins proportionate to what we save on the OPEX through technology initiatives. So these are the two questions here.
Okay, let me take that. The first question in terms of is technology going to crunch the time to take the share? If you think about our 10.5% loans share and 9.5% deposit share, which has come over a period of 25 years, we do believe that to make this 2x, it's not going to take the next 25 years. It's going to be a fraction of that. You are correct in your thought process in terms of you should be able to quickly go get this into a 2x type of market share. That's our execution approach, right? Certainly, we're marching towards that direction. And your other aspect of in terms of whether the cost benefit, how does it translate into customer, etc. Yes. See, at the end of the day, the pricing is risk-based pricing when it is an advances or loans. When it is a liability, it is again the optimal cost of getting the relationship at what price that you can get the relationship, so you can deepen it on the holistic approach. So the two principles: one, risk-based pricing; two, relationship-based pricing. So that's how one can go across. And at the same time, there are other things in terms of being best in class in terms of cost to income and best in class in terms of returns and so on. So those things we do want to maintain and improve where possible. But then at least these are the principles around which these things get executed.
Sure. Thank you.
Thank you, Anand. And Srini and Parag, thank you so much for sparing the time. We could have had a much longer discussion, but all good things come to an end. Thank you so much for being on this call and taking us through your thought processes.
Thank you. Thank you. It was a pleasure from us.
Thanks for having us. Yeah. Bye-bye.
Thank you for joining today's session. If you have any questions, please be in touch with your Jefferies representative. Thank you and goodbye.